So okay, can you hear me, please? Are you able to hear me?
Yes.
Okay, great. Thank you. Thank you for confirming. Okay. And can you see my screen? Are you able to see my screen? Are you able to see my screen?
Yeah, I can see your screen.
Okay, great. 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 Okay. So So the overview of this chapter, we're going through a number of calculation relating to the ratio. So what is the ratio and why we need to calculating a ratio in a company while they publishing their financial statement, including statement of the profit and loss and statement of financial position and statement of cash flow. Well, the reason we need to look at a ratio for the internal purpose and for external purpose. So when I say for external purpose, it means for the investor, for example. So investor usually they look at your financial statement and through a ratio. So they analyzing your performance, a company's performance through the ratio. Okay, so uh, during this chapter, so obviously we will interpreting a ratio, for example, analyzing, and for example, if we're looking at a revenue, so we need to comparing revenue with the past years and what is the differences between past year and the current year. For example, if we're looking at the revenue, then we're looking at the cost of revenue. If cost of revenue is go up again, we need to understand it why cost of revenue is go up. Okay, so this is the purpose of interpreting a ratio. So we can comparing, for example, revenue or sale with our assets. So imagine you have assets and you have a revenue. So you're looking at the relationship between your asset and revenue. So how much your assets are contributing toward your revenue. Probably you have some sort of assets does not make any contribution toward your revenue. So this is the purpose of this chapter and analyzing. For example, you're looking at your assets, what you own, and looking at your liability, what you owe. So you look at the differences between assets and liability through ratio analysis. Okay. For example, you're looking at the capital, some sort of your asset. What kind of asset do you have? You look at your cash level at bank and solvency. Okay, so we will look at a number of case study, and also I uploaded a question to Google Classroom, so we will go through the Google Classroom as well. Okay, so first of all, for ratio calculations, so we look at the profitability. Okay, we look at profitability, we look at investor. Okay, then we look at the liquidity, and we look at gearing. Okay, so in order to understand profitability, so we will analyze it through different method. Okay, so we are analyzing a company's profitability through number of a method. In terms of investor, also we look at investor through different method. Liquidity also same thing, and gearing. So profitability, it is relating to the profit of the company, and investor is looking at the level of investment, either through assets or either through the research and development. Liquidity, it is relating to how much the company is liquid, how much the level of debt. your liability. Okay, so how big is your liability figure? Simply, gearing also is relating to the capital. Okay, relating to the capital. Okay, so so types of ratio. This is the type of ratio. For example, profitability measure how profitable a business is. This is simple definition. Liquidity ratio, whether is the business able to meeting short-term obligation. Please let me know if you lost me or if you are unable to hear me. Please let me know. Okay, um, because I am on the different uh, screen. Uh, okay, so liquidity is obviously is about the short term. So when we are saying a short term, it means a current liability. Current liability, we know liability. Liability, it means you owe to supplier, you owe to financial institution, including bank. If you have a mortgage, for example, a long-term loan, taking long-term loan for investment or for the buying a new machinery for the company. So these are a long-term liability, but short-term liability, it is only short-term. It is for less than 12 months. Okay, it is less than 12 months. So the company should able to meeting um, their their requirement from the suppliers within 12 months. So always the company should able to meeting the suppliers requirement and making a payment on time. So obviously liquidity ratio always about the current liability. Current liability is for any anything you owe which is less than 12 months. So usually to understand your liquidity ratio, you compare your current liability with your current assets. So always a healthy business must their current asset greater than current liability. So if it is your current assets greater than your current liability by 1.2, 1.3, it would be great. So if it is less than 1, it is not good. So when we are calculating liquidity ratio, it means current assets divided by current liability. So it must be equal to 1 and above. If it is less than 1, so it means it is not a good indication for a company or for the business. Okay. So gearing ratio measures the extent a business is depending on the equity fund. So usually is gearing is relating to the equity fund. For example, uh, if you are a business and you need some capital because you have a planning to expanding your business, or you have a planning to investing in new project, or you have a planning to buy a new machinery, or you have a planning to investing in research and development. So you have two options to raising equity. The first option, you can go to the bank and asking for the loan, and if the bank is satisfied, then they will provide you with a loan. The second option, obviously, you can raising a capital through equity. Okay, so through the issuing equity, okay, through the issuing of equity, then you can raising capital. So each of them, they have a advantage and disadvantage. Okay, each of them, they have a disadvantage and disadvantage. For example, if you go to the bank asking for the loan, so the bank does not care whether you're making a profit or not, still they need the interest based on your loan. So it would be additional expenses for business, and if its business is not successful. However, if you're raising uh, capital through equity, it means so you're going to give up part of your business. You are going to give up part of business. Okay, so this is some advantage and disadvantage. So The last one, we can understanding financial statement through the investors ratio, through the investors ratio. So, for example, a capital structure. So capital structure funding through the equity or debt, which is just I explained it. Okay, so for profitability, liquidity, gearing, investors ratio, each of them they analyzing through different formula, and we will go through those formula. Okay, so far so good. Please let me know if you have any question. Please let me know. Okay, please let me know if you have any question. So far so good. Okay, let's go back. Let's go back to next page. So as I explained, based on my understanding, this chapter is really interesting, and it is involving a calculating, and you should not losing any mark for this chapter, any question relating to a ratio analysis. Okay, so first of all, we can understanding level of profitability of a company through return on capital employed. Okay, we can understanding profitability through return on capital employed. Okay, what does that mean, return on capital employed? So we can understanding return on capital employed through this formula. It says profit from operations. So when we saying profit from operation, it means from activity, physical activity of a business during the period. If it is 12 months period or it is 3 months, usually it is 12 month period if you relying on the financial statement and statement of profit and loss. So for profit from operations, so we can get this figure from statement of profit and loss. Okay, then we divide it by total equity plus non-current liability. So these two figures, we can get it and we can find it from statement of financial position, from statement of financial position. So in the exam, you will have a two statement of the profit and loss, and statement of the financial positions, and okay, and you have to calculating these. For example, it says what is the return on capital employed, and you need to find out the profit from operations, the last figure from your statement of the profit and loss, then another two figure added together from the statement of the financial position, such as a total equity plus non-current liability, then times 100, because we will get it in the percentage. It must be your result, it must be in percentage. Okay, the next one, it says return on shareholders fund, return on shareholders fund, return on shareholders fund. So return on shareholders fund, for example, profit after tax, okay, then divide by total equity. So it's totally depending on the question in the exam, what kind of the ratio does they ask for you. So remember, return on capital employed is looking at specific area. Return on shareholders fund looking at a different issue. Okay, so why this it says return on shareholders fund? For example, if you are investing in a company and you expecting some sort of a dividend, some sort of share from the profit, we're calling dividend. So we have a profit after tax, then we have a total equity, number of shares, okay, the total capital invested in the business. So you expecting, so whether it is going to be each shareholder receiving £3, £4, £1, 50p, or either sometimes zero. So that's why for some sort of investor, some investor they looking at this ratio, interpreting this ratio, how much they will getting back based on their investment. So the last one, it is gross profit percentage. So obviously, again, we can understanding interpreting businesses profitability through gross profit. Gross profit. So how we get a gross profit? Okay, so gross profit it means sales minus cost of sales, revenue minus cost of goods sold, revenue minus cost of goods sold, it is equal to gross profit. It is equal to gross profit. Okay, so always this figure, revenue or cost of goods sold, you can find this figure from statement of profit and loss. So the formula it says gross profit minus revenue. What is gross profit? Gross profit it means equal to revenue minus cost of goods sold. Cost of goods sold then times 100. Okay. Again, in terms of expenses, in terms of expenses, you will not see this for this requirement in exam. I never seen this requirement in exam before. So, but if it is asked, so specify expenses over a revenue, over revenue. For example, specify expenses probably is cost of goods sold or the other expenses. Okay, the other expenses. So again, you can find this figure from where? From statement of the profit and loss. Another ratio to analyzing business performance through operating profit. Operating profit. So it means profit from operations over revenue. If you remember the first one, um, uh, we says profit from operation over equity plus non-current liability. But this time we can compare profit with revenue. We can compare profit from operations with a revenue. So how much it is the relationship. Obviously, the purpose of analyzing company's financial statement through this ratio to understand a relationship between these items. For example, relationship between profit from operation and revenue, relationship between expenses and revenue, relationship between cost of goods sold and revenue. So this is the pure purpose of analyzing a ratio. Okay, so um, I already uploaded all formula on Google Classroom for you. It make it much easier for you. So obviously you can see it from here that I uploaded uh, all formula for you. This is all formula here. Make it easy. You can put it on the a note. Make a note and put it everywhere. Put it on your study desk. Put it on the your bed and put it on whatever. So make a small note. So it is quite small and you need to either memorizing this formula or just read it and read it until you understand it. Okay. Okay, so because I can guarantee you, so you will have a question in the exam. It is worth 10 to 15 mark based on this ratio. So you need to remember the formula. Without the formula, it means you cannot do anything. Okay, so you need to understand it and remember the formula. Anyway, let's go back. Okay, so far so good. Okay, everyone's still here. Okay, this is another relating to asset turnover. Also, company they have a different type of non-current asset. When I am saying non-current asset, it means a long-term asset, physical assets. For example, what is non-current asset? It could be machinery, it could be land, it could be building, it could be uh, fixture and fitting, and whatever. So it is there are so many types of non-current assets. Okay, so again, probably you have some sort of machinery, property, plant, and equipment, and these are all non-current assets. So as a business, probably you have a lot of assets, and some of the asset is make a good contribution toward your revenue, and some of your asset does not making any contribution toward your revenue. So um, as an accountant in the future, or as a finance, so you need to be brave enough to making a good decision, financial decision. Says, for example, you have you bought a machinery, um, and the machinery is cost you £2 million, and this machine, it has not been used um, uh, so much, and it does make a little contribution to what revenue. So uh, in this scenario, so you have an option. Probably you can say we can selling this machine, okay, and investing £2 million in a new project or new machine, okay. So that's the sort of decision you must make in the future as an accountant. So you need to understand how much your non-current assets is make a contribution toward your revenue. Okay, so if you have a revenue figure, uh, where we can find a revenue, we can find a revenue from statement of profit and loss. Where can we find non-current assets? We can find non-current asset from statement of financial position at the top, okay, at the top. So uh, then we can compare the association between revenue and non-current assets. So how much it make a contribution toward revenue, okay. So, or otherwise, there is another way to calculating the um, important of your asset. You can say total asset minus current liability. Again, it is coming to the same thing. So non-current asset um, or total asset. What is total asset? So total asset, it means a non-current asset plus current liability equal to total asset. So yeah, so again, is total asset. We can say um, we can say total asset minus current liability. Why current liability, non-current liability? Because current liability, remember, it is short-term obligation. Current liability, it is short-term obligation. Okay, short-term obligation. So company must able to meeting short-term obligation. Okay, so uh, as a business, you must meeting your short-term obligation, no options. However, you have a current asset. Current asset, it means also a short term. For example, a trade receivable. You sell your goods providing service on credit to customer. Says the uh, credit term is 30 days, so there is no guarantee to receiving a money or collecting money from a customer within 30 days. So you cannot put a guarantee. But however, if you purchasing from supplier and the credit term is 30 days, so it means you must meeting your obligation within 30 days. So for liability, it is your obligation. For assets, for current asset, there is no any obligation. There is no any guarantee if you can getting back your money from your customer within a time limited. Okay, so far so good. Yeah, please let me know if you lost me. Okay, yep, great. Okay, so let's move to next page. This time we focus on liquidity. This time we focus on liquidity. Again, if you remember liquidity, what I says. So, for example, if we look at the current ratio, it means we're looking at the current asset and current liability. We compare these two short term. Okay, one current asset, it means short term you own, short term asset you own, what you have in short term. Current liability, it means what you owe in short term. Both of them short term. Okay, one of them you own, asset you own, liabilities you owe. So always remember your current asset must be greater than your current liability by 1. So 1 and over. If it is greater than 1, it is better. But if it is less than 1, it is not good indication for a company. So it means the company may not able to meeting their short-term obligation within a time frame. So if you have a um, if you purchasing from supplier within 30 days and your current ratio is less than 1, so it means you have a problem. You may not able to pay your supplier. So what happens if you're not able to pay your supplier? Well, probably you will losing your supplier, and you never want to have a bad relationship with your supplier. So if you are a manufacturing company, so you always want to have a healthy relationship with your supplier in order to provide you with supply you with a goods in order you can making a product. Okay, so that's why it is important. So this is the way management accountant and financial accountant in the company, so they analyzing their performance. For example, the current ratio, one of the way to analyzing to understanding your current asset and current liability. So whether you are able to meeting um, your 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 supplier's demand within a time limit. Okay, so your current asset must be greater than current liability. Put it in your mind, okay? And it must be greater than 1. If it is less than 1, says your current asset, it is 90, and your current liability, it is 100. So it means it's going to be 0.9. So it is a huge problem. So because it is less than 1. Okay, so always your current asset must be greater than your current liability. So if you look at the company's financial statement, so you will see the current asset is greater than your current liability. Okay. Other way to calculating uh, your ratio, your current ratio, probably says the current asset minus investor, then divide by current liability. So there is two options to analyzing. For example, uh, investigating for example, investigating gender diversity in a company. Okay, so right now I am doing my analysis for my study for my PhD. So I am looking at the role of gender diversity at boardroom. So for example, I look at the gender. For example, if the company they have a two female, what's the impact on the performance of the company? If the company they have a three female director at the boardroom, what's the impact? Uh, or I look at the in terms of the percentage, whether it is if uh, the gender diversity at boardroom, if it is greater than 25% or less than 25%. Okay, so there is a different way to analyzing gender diversity, for example. So in this question also, there is a different way to analyzing the current assets. So we can say current asset over current liability. This is one way, or the other way we can say current asset minus investor, then divide by current liability. This is the other ways to um, understanding the current ratio, to understanding current ratio. Okay, so probably the first one may not suiting some company, so they will focus on the second options, or some company will focus on second option because it is suiting their purposes. So obviously, okay. Now this one is really important. Inventory holding period. So I assume you 90%, there is a possibility of 90% you will have a question relating to inventory. Okay, so why inventory? Okay, uh, imagine you are a manufacturing company, you making producing goods, and you are going to calculating how long your inventory is going to be stay in warehouse, how long it will take. Okay, then you compare inventory with the cost of sales. Okay, inventories with the cost of sales. So so you look at your house, your warehouse, because you have um, a, a number of staff who is only responsible to controlling inventory, and you need to understand how long your inventory is going to be stay in the warehouse, then you can sell it. Okay, inventory period. So, for example, if you uh, producing some sort of food, and you do not want to your goods stay in warehouse for a long time, because there is a risk of expiration date, there is a risk of damage, there is additional cost keeping goods in warehouse, for example renting warehouse, security of the warehouse, heat and light of the warehouse, expiration, damage. So there are so many risks against holding um, inventory in the warehouse. So we can calculate it through number of days, through number of days. In terms of the payable, for example, this is relating for how long it take to pay back your supplier. If you're purchasing goods based on payable, or based on the credit, and how long it take, how many days it will take to pay back supplier. Okay, if you're purchasing goods, and you need to uh, calculate how long, usually how the average, so for example the average number of days it takes to pay back your supplier. In terms of receivable, again, how long it takes to collecting the money from your customer for the service or for the items you sold. Okay, so receivable and payable. So again, uh, receiver receivable, we compare revenue with the trade receivable, and for the payable we compare trade payable with the cost of sales, cost of sales. So we almost there. Working capital cycle day, this is again another one. Inventory days plus receivable days and minus payable day. So usually if you want to how long it take working capital cycle, so for example between receivable and payable and inventory, so that's the way you're going to uh, using this formula. It is straightforward. Inventory plus receivable minus payable, and it gives you working capital cycles. So okay, we're almost there. Gearing, it is relating to the interest. Finance cost. What is finance cost? Finance cost is related to the loan you taking from bank. Okay, so when you're taking loan from bank, you have to pay interest. So we're calling interest as a finance cost, as a finance cost. So if we want to understanding our interest cover, so we compare what? Compare profit from operations with the finance cost, because uh, you taking loan from bank in order to improving your profit, in order to improving your revenue figure. So that's why you taking a loan from bank. So but in return you have to pay finance, you have to pay interest. So we compare interest cover through profit from operations and finance cost. Okay. So gearing, so we can say non-current liability dividing by equity plus non-current liability. So this is another way. Okay. Uh, Dividend cover. What is dividend? Have you ever heard about dividend? Dividend, it means if you investing in the company, so in return, the company will give you a proportion of the profit if they make a profit. So that proportion of the profit you are entitled to, we're calling dividend. Okay, so usually after tax, after everything, whatever is left, so you will divide it between shareholder. So we're calling dividend. Okay, we call it dividend. So imagine if you are a sole trade company and you have a company and the company is belong to say 3 people or 4 people, so they made a 10,000 or 20,000 profits. The 20,000 profit is it is divided between 4 peoples. Okay, divided between 4 peoples. Each of them is entitled to £5,000. Okay, so this is the dividend. Earning per share, EPS, it means earning per share. So, for example, you have you investing in Microsoft, you investing in Apple, you investing in um, BT groups. So whatever company you're investing in, so you're expecting uh, earning per your share. So you have a 20 share, you have 100 share. It is depending on number of shares. So for example, you have you're investing in Amazon, you have a 10 share, and right now each share, uh, a share price in Amazon, it is worth about £1,000. In Apple again is Microsoft again. So these companies' share price is very high. So if you're investing in this company, says for example you purchase 20 share from Amazon, it means you're investing £20,000 in Amazon, and you're expecting how much you will earn per share in a company. Okay, so price per share. So what this is what I explained it. So if you are investor investing in Amazon or Apple or Microsoft, so each of them, these companies' share price is very high, is very close to £1,000. Okay, so this is the way we calculating share. Okay, so uh, this is all for today. And in terms of interpreting a ratio, so you need to ratio calculate it through this a formula. Then you have to make your own decision. What do you think? What is causing? Okay, because you look at the, for example, you're looking at the uh, two figure. Okay, you look at the revenue and you're looking at the cost of revenue, cost of goods sold. And yeah, if it is the figure, it does not great. So it means your cost of goods sold, it is higher increased. That's why it is affecting on your gross profit. So in this way, you need to interpreting the outcome. Okay, you need to iterate in the outer. Okay, so let me share what I uploaded. Just click showing the question I uploaded to Google Classroom. So if we're looking at question question number 1, this is the question. Okay, guys, it says you work for this company, a book publisher, the director are looking at investing in this company, and they ask you to look at the following ratio. For example, what is the return on capital employed for 2004 and 3, operating profit percentage, gross profit percentage, and asset turnover. So where can we find this information? So okay, if we look at the Google Docs, I already shared it with you. Okay, I already shared it with you. So if you open your Google Docs, we can find the information from there. Okay, okay, this is the company. Remember what I says we need two statement. We need two statement of profit and loss, statement of financial position. So this is your statement of profit and loss. Okay, and this is your statement of the financial positions. For example, you have a revenue, you have a cost of sales, and you have a gross profit. This figure you need it. This is profit from operations, finance cost, profit before tax, profit for the year. Okay, these are the information we need. If we look at the financial position information, you have a non-current asset. This is the figure you needed. You have a current liability, you have a non-current liability, and you have an equity. Okay, so you need to using these figures and following the formula. I already provide you with the formula. Okay, so I need you to look at the answer and type your answer and submit it back to me. Then I will look at your answer and I will come back to you at half 11. So I will give you 1 hour. What time is it now? Is almost 11. Well, I will come back at 12 o'clock. I will give you 1 hour because this is a number of questions. I uploaded 3 questions. So make sure you read the question, please, and understand it. So question 1B, this time it asks you for a different requirement, and explanation meaning of each ratio, and comment on the performance shown by each of the ratios. Then we will look at the answer together. Okay, so it is same question, we already have it. So just look at the comment on the ratio and what's the performance. And the last one, this time it asks you the conclusion on how the overall performance has changed over the last 2 years. Remember, ratio, we are analyzing, we are investigating this year with the last year, and this year with the past 2-3 years. You look at your profit level in past 5 years, for example, how it is increasing and decreasing, how it is changing. Okay, so this is what I need you go through it. So I already uploaded BT Group's financial statement for you. So if you have seen it, so you can look at the information. Okay, so and I will see you 12 o'clock. So from 12 till 1 o'clock, we look at the answer of those questions. So we look at the answer of those questions. Thank you very much for your participation, and I will see you at 12 o'clock. I will see you at 12 o'clock. In meantime, I am here. I will not sign out. So if you have any question, please let me know. Please let me know if you have any question. So I am here. Okay. Well, you can submitting your answer separately through the email or through the just creating a document. So if you go to the question, so obviously you can creating a document for yourself and submitting your answer through creating a document. Okay, so when it's coming to say students answer, for example, Halima, uh, if you click on Halima, so it gives you a box to making a comment. Okay, to make a comment. Okay, says for example, hi. And so you can typing back. So you have options to the way to answer the question. So obviously you can creating a sheet or answering through the private comment. Or okay, all right. And I will see you at 12 o'clock. Please go through the question between now and 12 o'clock. Then from 12 o'clock, we will together looking at this question relating to ratio analysis. And thank you very much, and take your time and go through the question and take a break. Okay, see you at 12. And just let you know that I recorded the session and I will upload it. Okay, so just helping other students to catch up. Okay, helping other